Good morning. Today is October 6th, 2025, and let's get the ball rolling. So first of all, my oldest daughter said that the table was a little empty, so she made an Iron Man out of Lego and she gave that to me to put on the table. But anyhow, let's get the ball rolling. So first of all, the TSX climbed by 1% on Friday, finishing all-time records high and locking its sixth straight daily gain and the longest since early August. And 9 out of 11 sectors were in the green. So first, the best ones were technology because of Shopify, and also energy because of the crude oil, industrials, real estate, consumer discretions were all in the highs. The losers, unfortunately, were healthcare and communications, and pretty much it was a really good day for traders all in all on Friday. And it's much more anticipated than anything else, and we'll see how today goes when it comes to the markets. In real estate spotlight, I want to talk about Toronto today. I do have a caution about a little bit skewed data, but when we get into it, I'll explain it. So first of all, in Toronto, the ask to sale ratio was 0.996. That means if someone listed for $1 million, they sold it for $996,000. So it was under asking. So that means it was perfectly priced, and it was more so of a balanced market. And average sold price, this is where the skewing is, it's about $2 million. So that means that some houses or few houses did skew the data. But again, this is a 7-day data, not a month's data. So I can rest assured that housing in Toronto is not $2 million as of yet. And listings to sales ratios were around 27%. That means it's still a super buyer's market. And overall, it's still a great time to buy in Toronto. New listings did come down by 5% week over week, but up by 10% year over year. So there's still a lot of inventory coming into the market. Power sales. So there's about 10 power sales in all of Toronto right now, and 5 are from mix, and 2 are from 5 are from private, 2 are from mix, 3 from major lenders. So pretty much 70% of total power sales in Toronto for the last 7 days were from private or mix. Again, this is expected because one is the cost of borrowing is a little bit higher, and also there's other factors in other things as well. For example, there's appraisal, and even just life happens, right? So again, mix and privates do not lend for long time periods. It's a short-term band-aid. So please remember that when you do borrow from mix or privates. And also in other news as well, in News Spotlight about the Bank of Canada and the Feds. So Canada, the Bank of Canada plans to resume publishing baseline projections for the growth inflation in October monetary policy report. So after months of uncertainty around the U.S. tariffs, Governor Tiff Macklem finally decided, there's confidence in returning inflation data, and pressures are easing and tariffs are stabilizing. So Bank of Canada already did reduce the rate to 2.5% in September. It's the first rate cut in the last 6 months. But now, also there's a probability of a 55% rate cut by 0.25 on October 29th. And overall, it does seem it's a good thing, but there's only one reason that the Bank of Canada does do a rate cut. That's only if the economy is not doing too well. So there's a silver lining to that. And in macro news, so the Canada's public debt topped to $1.2 trillion, with the interest costs about $54 billion a year. That's double the pre-COVID levels. So households are devoting 15 cents on every dollar towards debt service. That's a record high. So pretty much 15% of our income and our resources are dedicated to debts. But in other news as well, there's 34,000 jobs were added in September. Unemployment did go to 6.3%, and wages were up by 4.8%, and hours worked was flat. So pretty much unemployment's a little higher, wages are a little bit higher, but overall, we're not doing too well And that's probably the reason why the Bank of Canada is going to reduce the rates once again. And the next thing I want to talk about is something I've been bugged about for the last few days, about the OSFI news about cleaning up the capital treatment in income producing residential real estate. So pretty much the banks can no longer double count your property cash flow and borrower's income, and it's going to expect tighter lending to investors with new credit risk management and framework. This is going to land in January 2026, merging guidelines with the B20 and the B15. So I think this is long overdue, especially in cities like Toronto. But again, there's nothing that's going to happen until January 2026. Until then, landlords can go and invest more homes without any scrutiny, well, other than income. And in other news, in world news, Mark Carney is going to Washington this week to meet with Donald J. Trump in both countries to prepare for the CUSMA review. And tariffs between 20 to 25% to 50% on auto, steel, lumber are on the table. And also Alberta Premier Daniel Smith is saying that Alberta and Ottawa is almost 80% in decision about the pipelines. And all this matters because if, let's say, there is a 10% increase in tariffs on lumber, then there's a chance that $20,000 to $30,000 would be the cost increase on a detached home in Toronto for new build. And also in immigration, there's a higher chance that they're going to bring in more qualified people coming into the country, and they're going to be bringing the pool a lot less. So they're going to be focusing more on trades and skilled labor than anything else in the next few years. Also in currencies, so oil weekly decline and weekly trade data left Canada in a very low position. But even though there was a bounce on Friday, so US Canada remains bullish around $1.40, and it's a second time high. So what this means is $1 US is $1.40 Canadian. And what's going to happen is more chances, if there's a rate decrease in the Bank of Canada, there's a higher chance the difference will be increasing because our value of the Canadian dollar will be going down as the interest rates go down as well. So, there is a fine balance that the Bank of Canada does have to do in the next few weeks to see, if it considers what the international consideration for our currency value would be because of the rate cut as well. But I don't think they're going to look at it too much. I think they're going to focus mainly on microeconomic situations like jobs, GDP, and overall local situations than international for the time being. But again, we don't know until the next few weeks where more data is going to come in for the month of October. Then I can probably gauge a little bit better by the last week of October to say if it's going to be a sure rate cut or if they're not going to be a rate cut or pause. But until then, have a safe Monday, and then I'll see you guys on Tuesday.